All right, so the S&P followed up a really good day on Thursday with a strong, with a continuation of that move today. So really good move, really strong returns has led to some really bullish signals over the last couple of days. So I'm going to break down what those bullish signals are. I'm going to also show you when we've seen them before. We've actually seen a lot of these signals before already this year. So I'm going to break down when we've seen these before. We're going to break down too the implications, the long-term implications. There's a few of these signals we got by the end of the week that we don't get very often. And again, we got one other time this year, and I'm going to show you the long-term implications of those signals and what we can expect to see going forward from here. We're going to take a look at what's been driving a lot of this bullishness, not just over the last couple of days, because the bullishness over the last couple of days is actually different than the previous 4 to 6 weeks. So I'm going to break down what's changed, what was driving the bullishness, what's changed with the CPI report that we had this week, and what we can expect to see going forward. And then our trade idea of the day is a way to try to take advantage of this extreme rally. So we'll talk about that. Let's go ahead and get started. Today is Friday, November the 11th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below the video. You can also hit that thumbs up icon down below there. Comment down there on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these things over here on the right, including our upcoming classes that we have for this upcoming week. Come down here, click on this heart, it opens up this tab, hit that like button. Same thing here, hit that thumbs up icon, hit that like button. Again, the more you do that, it helps get our content out to all of our followers. We got up to 75, so let's see, the 100 mark is our goal that we try to shoot for, so if you can click that, it really goes a long way for us. We appreciate those who do. Also wanted to give again a shout out to Paul for the support, for the super thanks. You can see as a way through YouTube to be able to support these videos that we put on to YouTube day in and day out. You can just see, you can click any of these numbers and hit buy and send there. And like I said, this goes a long way too, hitting the likes that you can do right now even while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished the day really up again, so holding all of yesterday's gains and then building a little bit upon it. Really good move. Again, got the intermediate line back into the upper reversal zone. It did it over here and earlier in October, at the end of October, and now again here. Near-term line jumping up to its highest level that it's seen in a long, long time, right? It did get up to 97.5 at the end. That was the highest level of that rally, 97.5. It also got up over here to 98 and 97.8 at the end of this rally. So probably maybe not the best thing. It's good to get at the beginning of a move. Maybe not the best thing when we've already been in the intermediate run, especially at a resistance level at 4,000 here. So let's see how the market handles that strong move. I mean, it's kind of hard not to have a strong short-term indicators when you've had that big of a move. For the Nasdaq, well, they've only had 14 Nasdaq returns. I tweeted out over the week. On Friday, I tweeted out the return for the Nasdaq over 2 days is like one of the biggest returns over, like only in 2002, 2008, and 1998 were the only times we've had that big of a return on the Nasdaq over the course of 2 days. So essentially, every time we've had this big of a return over 2 days has been bear markets, not setting the lows, but in the middle of bear markets, and then coming off of the long-term capital management low point in 1998. That's the only time it did start a new run. The other 12 times, it did not. The bear market continued. So really interesting to see how the Nasdaq handles this. The Nasdaq ended up itself getting above this 30% retracement, this 50% retracement of the 50% retracement of the post-COVID rally, and you can see that 23% retracement of this year-to-date decline is sitting right here. So it's not quite necessarily breaking out nearly as strongly as the other indexes, but it's trying to catch up over the last couple of days for sure. You are 5% up above. The intermediate line now is in the upper bullish territory, so you got dark green shading, and a green line. You can see the Russell 2000 is up against its 62% retracement, as well as the 38% retracement of the post-COVID rally. So you can see they all are up against some retracement levels here, just different ones, but they're all up against something. The S&P, the NASDAQ, the Dow. The Dow not so much. If you look at the Dow, it's up against the 62% retracement of the year-term decline, above the 78% retracement of the current intermediate decline, so big break there, and then above this 23% retracement of the post-COVID rally. So you can see it's a lot more bullish. In fact, the 6-week rally for the Dow, this is the 4th time that we've had a 17.5% or more 6-week rally. There's only 4 other times. And in fact, if you see the tweet here, I'll bring out the tweet for you so you can see it. There you go. So you can see it on this screen. Only 4 other times. See, this is the NASDAQ one. Here, let me see. No, this is it. Only 4 other times for the Dow Jones since 1970. 3 other times. This is the 4th. Since 1970, the Dow has gained 17.5% in 6 weeks. This is a 6-week rate of change. It's been twice in the past couple of years. But at the time, we were 18, almost 20% below the 200-week moving average at the time. The other 2 times occurred in 08 and 74. We were 42% and 35% below the 200-week moving average at the time of those lows, that when the 6-week run started. So in other words, all the other 3 times we were coming off of major lows, even the COVID low, coming off of major lows. This one we were only 3.5% below, so not nearly a major low, yet the market's treating it as such. The other thing too that someone asked, what does this mean? To kind of give you an idea of how I reply to this. Here we go. This is the kind of move that occurs after the Fed is done cutting rates. So in all those other 3 instances, the Fed was cutting rates and was done cutting rates, and then the market rallied that much. So this, obviously the Fed's not done raising rates. They haven't even started cutting rates, and we've already gotten this kind of a move. So needless to say, this has been a pretty historical period. For the Dow, it's been over 6 weeks. For the NASDAQ, it's been the last 2 days. This is the chart. Let's see, that was the Dow's chart. Let me see if I can find. Here's the NASDAQ's chart, right? So again, look, this is the return, the 2-day. This is actually because it's a 2-day chart. So this is a 2-day return for the NASDAQ. Look, nothing touches it over the last 2 days. Not even coming out the COVID lows. The only other times, in this case since 1990, the only other times were 3 times in 2008. Remember, we didn't set the low point until March 2009 on the S&P 500, and then you can see we didn't get that big of a return coming off those lows. And then the other 12 times, there's 9 times, excuse me, were all during this 2000 to 2002 run. The market bottomed in March of 03 over here off the chart. So all these other times, 1, 2, 3, 4, 5, 6, 7, 8, 9 times occurred all during this bear market, not setting the lows on either one of these. Right? It wasn't until March of 03, and we didn't get a big 2-day run. And then the other time, the only other time, is right over here in 1998, again coming off of the long-term capital management debacle, and you can see the market rallied higher, of course, and the NASDAQ just took off all the way up to its March 2000 peak, went parabolic. Remember, it was way above the 200-week moving average at that time, so we were in a really strong bullish move there. So when you look at the 2-day return on the NASDAQ, you look at that 6-week return on the Dow, and then if you look at the 10-day return, it's right, let's see, let me find it. No. See, it's right here. So this is 10% in the last 20 days. This was actually on, this would have been on, Friday. So this is Friday morning. So this is that has rallied 10% in 20 days. You can see typically, that's a mark of coming off of a correction low point. All of these instances, we were coming off of correction low points until what we had over here, and now we are again 10%. So again, the market is like looking at this move this week as as either the beginning of a correction of a move off of a correction low. Because technically, again, this is not like we have not broken the 200-week moving average. We did just a little bit. Like it's not this from if you use that as your definition for a bear market, because bear markets take years to recover. If we were to get back to 4,800, it's not going to take years, right? So that's why this is not a bear market. If we get back to 4,800, I mean, the Dow is already almost back to its all-time highs. So if we get back to 4,800, it will be within a few months here. So that's what this kind of move suggests. Or it suggests a tremendous fake out, because that's what we've just got, right? And there's another sign here on the S&P 500. If you go to its weekly market forecast, you can see it got this bear tag here. Second time this year. This bear tag means that we close above a falling, this would be a 30-week simple moving average. So we closed above, and not by very much, by 1%. Right? Again, you have to get above 2.5% to change the trend. So we close above it by just over 1%. And then the other part of the bear tag is the light green shading, you can see. So it's a yellow line, light green shading. The light green shading means the intermediate line is rising above 20. And you were up here. Once it gets above 50, then it's going to be dark green shading. But when it's below 50, when the intermediate line is below 50, you either have dark green, pink shading or light green shading, depending upon whether it's going up or down. And now it's going up. You're still below 50, but you're going up, so light green shading. That's a bear tag. Bear tags on a weekly chart. So this is a long-term chart, has long-term implications. A bear tag. Let me show you what happens. If you want to go back to my market outlook video on the week of the Friday of August the 8th, I believe August 8th was a Monday. So whatever Friday that was, watch that market outlook over that weekend. It's the same thing, right? So if you go back to some of these other bear tags, so you can see we haven't had one. Here, let's go back to 1958. It's been a while since we had one. The last one we had was over here in 2016, coming off that correction low point. We didn't have one in 18 or 20 coming off those correction lows, but we did one here. So the bear tag has the potential of starting a very good bullish rally, like multiple years. You can see it there. You can see it here in 2011. It can start a multiple year-long bullish rally. This is a weekly chart. And here's another one right here in 2010. Really good long run. Or it can start a bear market, right? A real bear market. Not like the media is telling me it's a bear market because they don't know what they're talking about. But a real bear market. For people who have traded in 2008, they know what a real bear market feels like. Like this is not a bear market. This is a bear market, right? There's a different feel there. That it's not even here. You don't even feel that here. It's not the same here right now as what you saw in 2008 or what you saw over here when you got that bear tag, right? You can see that things just really hit the fan there. And so you can see bear tags either lead to a bear market or a multi-year bullish run, like really good coming off of these lows. You can see another one over there in 2004. You can see another one here in 1998 coming off of that level. Another one here in 1994 when the Fed was raising rates. 1994. Another one here in 1990. You can see they can be either really bearish or really bullish. Not just, not just hey, market might go up or down tomorrow. It's like we are either starting a multi-year bullish run and easily getting up to 4,800 within a few months, or if we do what we did here, we're going to start a bear market, right? We're going to start a bear market here. So very, very important to see how we build on this bear tag. And you can see we actually got that signal last week. So not even this week, but we got that signal here last week on the Dow, or 2 weeks ago on the Dow. And we've really kind of taken off and gotten 6% above the moving average. So the Dow is actually looking really, really good. Over here it didn't get 2.5% above, but now we are 6% above. So very, very good sign for the Dow. The NASDAQ again, on the other hand, here, let's go back to a 5-year. No bear tag because we're not above that moving average. We're not even close to the 30-week moving average. So it kind of gives you an idea of the discrepancy you're seeing in the markets right now the types of stocks. So Russell 2000 also got that bear tag here this week. We are 3.75% above. This is a little bit higher number. As you can see, we got up to 5.5% over here on that bear tag. Had one more week after it got its bear tag before turning over. So really important week this week that we don't turn over, that we don't match this kind of week to the back to the downside this next week. Otherwise, again, the implications of that bear tag has got long-term consequences in terms of multi-year bullish run starting right here, or the actual washout phase of the bear market starting right here. So really, really important levels going forward from here. You can see the other weekly chart we like to look at. This is the Hakinyashi candle. It's got a bullish candle here. We are got a green arrow. The PPO is rising. So you actually have all three signs here looking pretty good on this weekly chart. There's another one we look at too. We look at the whole. The daily chart's looking outstanding. The weekly chart's not quite there yet. We're almost about to flip that. If we get a new high, like if we can really bust out this week, then we can really flip that around, that parabolic star, and move it to the downside. The green, the hull's already turned up, and obviously you're getting a bullish candle. We didn't close above those highs. That would have been preferred because we got that lower close. It would have been really nice to close above those highs. At least close above the body. So that's a good sign. And it would, if we can flip that parabolic star down to the downside, then you can see we can get a good weekly run starting. Remember, a lot of the indicators we're seeing now is what we saw here on that week when we had already turned quite a bit. And we haven't quite turned yet we're already seeing the same types of really overbought conditions there. We talked yesterday on some of these oscillators. Here, let's actually look at the 3 green arrow chart first. Really good sign here that we're getting a couple of days in a row of green arrows, and it looks like we will, barring a collapse the next couple of days. It looks like we'll have a few more days of 3 green arrows, so that's a good sign for us. The Dow has been 3 green for a lot longer. The Qs had 3 red arrows. It's turned back to 3 green, and of course your Russell. So we've got a couple of good days. Again, if we can get 5 more of 3 green arrow days by the end of this week, we're solid, right? We are solid in that. Looking at when you break those lines up, you can see where those Fibonacci lines are. You can see we're still filling in the gap between the 50 and the 200-day moving averages. One really positive sign that we have, in terms of like this time versus the last time. The last time you see we broke the 8-day 1 week, we broke the 17-day the next week, we broke the 32 weeks later. So 1 week at a time we broke each of these lines, and we eventually just filled in the gap between the 30 and the 50. This go around, we broke above the 8 and the 17 in 1 week before falling back, and then now we broke above the 8, 17, and the 30 all in the same week. 8, 17, and 30 week moving averages. It's a very, very good sign. We didn't get that over here. You didn't even get that over here. We broke above the 8 and this kind of the 17 and the 30 at the same time, and then didn't hold it. Breaking above multiple moving averages is a very good development. So if there's anything that suggests that we can be really bullish here, aside from that bear tag, and aside from the other sign, the 10% rally over 20 days, this is another one, right? Getting above multiple moving averages suggests we could just really take off from here. Regardless of what the macro environment says, right? The technical environment says, again, that we could really take off from here. But the problem with that is that's kind of what we looked like in August. And, when the technical environment says one thing and you get a fake out, then that's even worse than just resistance holding in the first place. Because it's, again, a lot of people see these same signals and see, oh, it's time to be really bullish, right? Because they're seeing all these patterns develop. One thing we're not quite seeing that would be better is to get above 70 on the RSI. You can see when we had this move in August, again, when we were 10% above in 20 days, we were above 70 in the RSI. This time, we're just barely above 60. Now, we are above 60, so that's good, but we're not really breaking out like above 70 like you would like to see on this really strong of a bullish move. At least the CCI is up above 188, so that is a positive development there. The DMI also broke out, so we finally did get above 25 on the positive. That took a while, but we finally did here yesterday. and then followed through and kept that above 32. The negative is there below 20. The negative is forming as of right now a higher low. So that would say the negative higher lows, and again, just for now, right, because it can just keep going down. But as of right now, the higher lows on the negative indicator, the purple line, would suggest that we'd be getting lower highs on the index itself. And so when you don't get lower highs, then that's a divergence. So that's something to keep an eye on, even with this spike that you've seen in the green line. You can see we got a spike above 30 over here on the green line, but we didn't quite get that divergence. You can see we were just barely below 25 on that level. And you can see over here in March, we got above 30 on the positive indicator, and we did get below 20. And then that was another one of the failed attempts this year. So another one of those 10% moves. So, that's something to keep an eye on as well. Let's take a look here at the Ichimoku cloud. We weren't above the cloud yesterday, but we did get above it with that small move today. The red line is way above price, so like the rate of change over 26 days is strongly positive. So that's a good sign. So again, that red line right here, this red line, it's a visualization of this rate of change over 26 days. So obviously turning positive is a good sign for the trend turning positive. You can see it's at 6%. It did get up to 6% over here as well, and that was about the limit. It actually got higher. It got over 10% here in August, and again, kind of the signal of the fake out, of how much of a fake out that was. So that's kind of something important to watch. You can see on some of these other, COVID got really high. Over here it got above 12%. So you would like this to get a little bit higher if you really want to turn things around. You'd like to see again, we have a weak bullish trend going. We're not quite above 2.5. We're not quite above 65. So we're there. We're getting to a good trend developing here. You can see the stochastic indicator is the orange line's almost in the reversal zone. Remember, it did get in the reversal zone in March, but by the time it did, the blue line was below it. It got in the reversal zone here. The blue line was still above it. So you had a good sign there, and then now we're about to get in the reversal zone again. And again, getting above these lines right here at 4,000 would be just a tremendous opportunity for the markets, long-term opportunity for the markets. Let's take a look at the Bollinger Bands. We did get outside the band, and you got outside the Keltner channels. So another good sign for the markets going forward here. Outside the Bollinger Bands, outside the Keltner channels. Again, we did that over here too. So in August, and we kept going up for another week. So it's, this is what you would like to see when you're bullish. Again, you would like to see, you would like to be on a bullish trend. We're just not quite there yet on some of these indicators. The trend strength's not quite there yet. As we talked about, the RSI is not very high. We've also talked about like the McClellan oscillator, is not very strong. It's considering how bearish we've been. We did get below minus 100, so you'd like to see us get above positive 100. We didn't quite get there. We didn't get the 90% volume. We were just below 90% up volume on the New York Stock Exchange there on Thursday. Then yesterday, but we were above 80, so that means we can replace that because that 90% signal is a very good thrust signal to start a bullish trend. So you can if you don't get it, you can replace it with a 2-day move, consecutive move of over 80% up volume on the advancers on the New York Stock Exchange relative to total volume. And we missed that. So, and that's a long time, Walter Deemer, a long time technical analyst, even he tweeted out how crazy weird it was, because that's a rare move. Like Thursday's move, was an unbelievably rare move. You can see it's the biggest move all year. It's a rare move for it to get that high, especially when we didn't have a strong move. I mean, we had it over here, but you were coming off of a major low. You had it over here, but you were also coming off of multiple big lows. This time, we had it, but no significant low point that we're coming off of. So for that to not produce a 90% up volume day was kind of different. And then you follow up with a 1% move that also did not produce an 80% volume day kind of stands out. It stands out as kind of odd because that's not typical at all for the type of move that you need to stop the bearishness, right? And start the engine, right? Turn things around. Again, you've got the signals. You got that, you know, the 10% move over 20 days, the bear tag signal. You've got a lot of signals that suggest the break above the 8, 17, 30 week moving averages. You got a lot of signals that suggest we can take off from here. Whether we believe it or not, whether we think the macro situation calls for it or not, doesn't matter. The technical signal suggests we could really take off from here. But like I mentioned before, we had this before in August. And the last time that we had this, the Fed made a pointed effort, I believe personally, that Chairman Powell changed his Jackson Hole speech because of the move in order to make sure the market understood because it didn't seem like the market did. So now the question is, will the Fed continue to make a pointed effort to resolve what it's seeing right now? Because if not, if the Fed does approve of this move, we are rocket ship go, right, to new highs and beyond. Otherwise, again, as bad of a fake out as that was in August, this probably has more potential to be even a worse fake out because of the historical moves we've gotten in the last 2 days, in the last 10 days for the S&P, in the last 6 weeks for the Dow. All right, one more thing. Let's take a look at the VIX, the VIX indicator. So the VIX, considering how bullish we've been, should be down, and it was down a lot. You can see it drop down to well below 90%, so big drop. It's down to 22.5. It's not down below 20 yet, but it's, you know, this is the best drop that we've seen in the VIX in quite some time. The volatility of the VIX stayed relatively high at 86. When you look at the correlation, the VIX correlation here, let's see, let's pull up the VIX over the last 10 days. Again, we saw this in August. The correlation between the VIX and the VVIX is negative on something that is historically very positive. And generally speaking, this leads to a spike in the VIX. We talked about this in August too, and we talked about this rare negative correlation. And here we are again with a rare negative correlation between the VIX and the VVIX. And you can also see again, we talked about earlier a few days ago about the correlation between the positive correlation between the VIX and the S&P, which typically leads to a bounce in the VIX. As of right now, it's gone worse and brought the VVIX correlation down, and so we're really setting up for something on the volatility that we may not. I mean, again, it would have been a much better had we not set up again, unless we take off from here, which all signs suggest that we would. If this ends up being a fake out like mid-August, I actually think this actually ends up being worse than the fake out in mid-August, because again, you didn't see that spike here in mid-August, and you didn't see the types of moves we've got in the last 2 days, in the last 6 weeks, in the last 10 days that we saw. You did see at the very end in mid-August that 10-day move on the S&P, but not that down move. So we are setting up for an even worse fake out move if this doesn't work out than what we saw there in August, which was even worse than the one that we saw at the end of March. All right, now let's take a look at what's happening here, what's driving the price action in the last couple of days. So today you can see, look at that big 1.5% drop in the dollar. Emerging markets took off, way outpacing the S&P. The Qs outpaced the S&P as well in the IWM. Gold benefiting as well from the dollar. The bond market was closed, so pretty flat moves. The global bond markets were down, yields higher. All right, so now let's take a look at the last 2 days, this historic 2-day rally, right? We'll look at the last 2 days and say, okay, well, again, the dollar down 3.75% in just 2 days. Again, the big reason for this post CPI move, you have a big jump in the Qs. The Qs up 9%, so there's that 9% number, a 9.4% rally for the Qs over 2 days. Very, like, again, only in the depths of bear markets, and only once has it led to a bullish trend in 1998, which was not a bear market, right? It was just a deep correction there. You can see gold benefiting, bonds were up, yields were down. But look at commodities being sneakily up there, kind of matching that. So now let's go over the last 4 weeks. That's that 20-day period that the S&P has been up 10%. So 1, 2, 3, 4. So going all the way back to the 17th. And you can see here that here's the 20-day period. The S&P is up 11%, so over 10% rally for the S&P in 10 days. Again, most of that weakness in the dollar is recent, but down 6% weakness in the dollar. You can see international stocks doing well, real estate bouncing back up, gold benefiting from the drop in the dollar here recently, and you can see commodities kind of flat and really underperforming. And a lot of the gains in the equities rallied early, kind of flat, and then rallied here late. Now let's go back to that last 6 weeks, right? That would add another 2 weeks here. This is the historic move in the Dow, so you have to go 6 weeks now. This is the big move that we've had in the Dow Jones Industrial Average. Again, the S&P is up pretty much the same. But remember, the Dow is up 17.5% over this period, over this 6 week period. You can see the Qs were actually down over this 6 week period. Here, let me just make sure. Yeah, so we have I'm gonna make sure I have the time here. So 1, 2, 3, 4, 5, and then 6. Okay, and then let me just make sure that I have it all on the same. Okay, I do. Okay, so it's all on the same chart here. The Qs were negative for the 6 weeks until the last 2 days. So the Dow has been on this historic run, like again, only 3 other times since 1970, and the Qs were down. We're down until the last 2 days, and you can see the dollar move, and you can see bond yields were actually pretty strong for most of that period. So bonds were down until the last 2 days. So the developed markets doing really well, emerging markets doing really well for most of this period, and of course IWM, which is more closely correlated to the Dow because it's the same kind of financials, industrials, materials type stocks. It is outperforming, way outperforming the Qs, especially up until again this last couple days. So you can see the kind of moves that we're seeing here. Again, from a sector standpoint, look at the sector comparison and look at just how things moved here today. So let's go back to November. Just today alone, here on Friday, it's energy and your 3 big cyclical areas, and industrials, financials, materials, kind of matching the market, lagging behind. Safe haven areas lagging behind as well. That's not surprising. Let's go out. The last 2 days, this historic run on the Nasdaq. You can see XLY, XLK up 10%, XLC up 9%. I mean, these are some really bad, beaten up sectors. Year to date, they've been horrible, real estate, but they've been the biggest movers over the last 2 days. And you can see staples, utilities. Utilities are up. Industrials, all up. They're just not up as much, right? They've been outperforming, especially these safe haven areas. Let's go out the last 4 weeks. So here's that 20-day period. The S&P is up 10%. XOK, this has been a recent phenomenon for these XOK, XOY, XOC. They were actually lagging before these last 2 days, and it was financials, industrials, materials, and energy that were leading the way higher for most of this 4-week period. And you go back to the 6-week period that's been historic for the Dow. Again, industrials, energy, materials, financials killing everything over that period. Again, not necessarily the types of, we've seen these stocks lead the markets higher before in the past couple of years, and when they did, it led to a parabolic peak that the market couldn't sustain. What you want to see is what we've seen in the last 2 days. These beaten up sectors, these areas that have been the big winners here year to date. And if I were to go year to date, these areas are the ones that have been the biggest losers. They've been the biggest winners over the last 2 days. They're the ones you want to lead higher. See, these other areas have had a good run over 6 weeks here from 10.3. You can see the good run that they've had. But they've been pretty much outperforming these other areas for most of the year. Not necessarily. We've seen these. They led the way higher here into this peak in the May. This is not the sectors we want to lead the market higher, considering the much higher weightings that these larger sectors have in the S&P 500. All right, now let's take a look at our trade idea for the day. I want to take a look at FCX. FCX has been one of these material companies that has done really, really well, and you can see it got all the way up, kind of really gone parabolic, a little bit of a long upper shadow, but it's gone parabolic, especially not necessarily the last couple of days, though. It's had, I mean, look at these big gaps. If you look at on this chart, you can see some really tremendous gaps on FCX, some big time gaps. Today, yesterday, and then back over here on the 4th. So some significant moves in the stock. Of course, you are, excuse me, get back to FCX here. You are 21% above the 30-day moving average, which is the highest of the year. If I were to go back the last 5 years, it's not quite the highest of the last 5 years, but you can kind of see it generally only gets this high when you're in a bullish market. And you can see some other instances where it kind of peaks over here early in 2018. We got up to that level. So needless to say, it's gone, parabolic here. If you look at its DMI chart, you can see its positive indicator has gone up to 39. This is a really high level. When you get up to 40, you can see it tends to follow the peaks here on these other instances. In this case, you're getting a higher low point on the negative indicator. Again, remember I told you before that typically suggests lower high points on the price. So a significant divergence developing there on that DMI pattern. You can see the RSI and the CCI. Again, you would expect that they would be at strong levels, above 70, above 200, and not quite necessarily matching the strength that you see in this parabolic type move. Not quite the mature bullish trend there, very far up above the rate of change, strongly higher. You can take a look at the 3 green arrow chart, and you can see we're sitting right up against this 50% retracement of this year-to-date decline that we've been on, just a smidgen above the 200-day moving average, and right at this point of control, not necessarily the point of control, but this big volume node here, just over 38. Obviously, there's some resistance. There's some price action that's been traded in this spot, and sets up for the possibility of maybe a little too much of a move starting to correct some of that move to the downside. And so what I decided to do was say, okay, if this keeps going up, then we're going to know really easily if it's not going to work out. So I want to do something aggressive, low risk trade, low probability, but a low risk trade. You can see I've already got in our class portfolio an iron condor spread. But what I'm going to do here is I'm going to set up a 33.35 bear put spread. Let me show you what that looks like here. It sets up a bear put spread. It's about a 3-to-1 reward to risk ratio. If we drop down below 33, then it pays out. And you can see 33 essentially is filling in these gaps and then some, right? So if it works out, great. If it doesn't work out, then I take a couple $100 of loss on this, which, for $1,500 of reward, I'd be more than willing to take a couple $100 of loss for that type of reward to risk setup. And like I said, already up a little bit since we got into this trade because we're getting that long upper shadow, so a little bit of a decline, and that's not necessarily the best sign either when you're getting long upper shadows like that. So we'll see how that plays out going into early next week. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.